Good afternoon. So I was noticing that I did not have a video made for you for the aging of the accounts receivable method of figuring what the allowance for doubtful accounts should be. So if you will look on your printable exercises for the accounts receivable unit, you will see that exercise 3 is based on that method. And I'm going to work through this one for you so you'll be able to do it. So the whole idea behind the aging method is that as our customers don't pay us on time, the longer they go without paying us, the less likely it is that they're ever going to pay us. So for example, if one of my customers is just, let's say everybody's supposed to pay us in 30 days. If we've got a customer that's just like at 40 days, maybe we have a relationship with them, we know that they'll pay us, etc. But if it goes another 30 days, pretty soon it's not looking like we're ever going to get paid. Pretty soon it's looking like they're going to file bankruptcy or something. So that's the whole idea behind this methodology, and honestly I will tell you that it is the most used of the 3 methods that we learned about: a percentage of sales, using a percentage of sales as bad debts, using a percentage of accounts receivable as bad debts, or doing an aging and figuring it based off of that. The aging method is the most used method out in the real world. So if you look at this problem that I posted for you, you will see that we've got $570,000 total that our customers owe us. $396,000 is not overdue. Notice that this up here, this heading says that this is how many days past due. It's not how many days have gone by since we sold them stuff. It's how many days are past due. So if you're not past due, that means you're somewhere within that 30 days that you were supposed to pay us. Then we've got people 1 to 30 days overdue. We've got accounts that are 31 to 60, 61 to 90, and then over 90. And then you will notice that the client, the company, has used their historical experience, and they've said, well, we know that almost everybody will pay us out of the group that's not overdue. And you can see that as they get older, it's more likely that people won't pay. So by the time somebody is over 90 days old, there's a 10% chance that they will never pay their bill. In this company, in some companies, it's much worse. Everybody has their own past experience, and unless you're a brand new company, you kind of rely on your past experience with your customers. So the first thing we're going to do is we're going to use these probabilities that the accounts are going to go bad to figure what the allowance for doubtful accounts should be. So we've got 1% of 396,000. That would easily be, that's an easy one for us, 3960. I'm going to flip around so I can write easier. So I'm just taking 1% times 396,000 and getting 3960. Okay, the next category is 2% of 90,000. That would be 1800. The next older category is 36,000 times 5%. That's also 1800. The next category, the 61 to 90 days overdue, we've got 18,000 outstanding in that category at 7%. That works out to be 1260. And 10% of 30,000 in the oldest category. So if I just add these up along the way, we end up with 11,820 is what we believe is going to go bad out of the accounts receivable that we have now. So then the problem says, okay, that's fine. You've worked out those dollar amounts, But what do you need to do with it? Well, in the allowance method, we are calculating what we want the ending allowance to be after our journal entry. So part B says, what if the allowance account had a $3,600 credit balance right now before we make the adjustment? Okay, well, if that's the case, then remember that what we found was what we want it to be. So we have solved for the ending balance. So we need to solve for the entry that will get us to $11,820. Okay? So the difference between $3,600 and $11,820 is that we need to make a journal entry for $8,220. So we will debit bad debt expense and credit the allowance for doubtful accounts for $8,220. So that's B. C says, what if we had a debit balance in the allowance account before we do this analysis? Now, how in the world could we have a debit balance in the allowance account? Well, what that means is that we actually wrote off more accounts over the course of the year than we had thought we would have to last year. So we ate up the allowance account by writing off more accounts all year long. I still need to get this account up to $11,820. So it's going to take me 100 to wipe out this debit to zero, and another $11,820 to get me to a credit of $11,820. So that would take $11,920 to turn a $100 debit into an $11,820 credit. Again, debit bad debt expense, credit allowance for doubtful accounts. Okay, great. Good luck working on your exercises.